Welcome to the Career Research Channel. If you want to know why the next generation of artificial intelligence just got massively more expensive to build, well, you actually shouldn't be looking at Silicon Valley.
Right, not at all.
Yeah. Instead, you need to look at a narrow 54 to 45 vote that happened in the U.S. Senate today. Because today, May 13th, 2026, the Senate just handed the master thermostat of the global economy to a man named Kevin Warsh.
He's the newly confirmed chair of the Federal Reserve, taking over for Jerome Powell.
Exactly. And that is what we are digging into today. But before we unpack this massive shift, and trust me, you are going to want to hear how this impacts everything from your mortgage to South Korea's tech dominance, please take a second to like this video and subscribe to the channel.
It really helps us keep doing these deep dives for you.
It really does. So we are taking a huge stack of financial, political, and geopolitical analysis today to figure out how this single personnel change in Washington is a signal that will dictate, your 401k, shift global markets, and structurally alter the future of global tech.
I really love that thermostat analogy, by the way. It holds up perfectly when you look at the actual mechanics of central banking.
How so?
Well, you turn the dial just a fraction of a degree in some basement in Washington, and the shock wave alters the temperature for literally everyone else on the planet. I mean, someone in Europe freezes, someone in Asia is suddenly sweating through their shirt.
Right. And Warsh is stepping into what looks like an incredibly volatile matrix right now.
Oh, absolutely. He isn't inheriting some quiet, stable economy. Right out of the gate, he is facing three opposing structural forces.
Okay, let's lay those out.
Sure. So first, you have President Trump pushing aggressively for lower interest rates to boost domestic growth. Second, you have a really stubborn inflation rate flashing bright red warning signs. And third, you have global capital markets watching like hawks, basically, to see if Warsh will protect the Fed's independence or if he'll fold to political pressure.
Okay, let's unpack this, because to understand what Warsh is going to do with that thermostat, we have to understand the specific economic fire he is walking into this morning.
Yeah, the data paints a pretty stark picture of where we are in April 2026.
Right. The U.S. Consumer Price Index, which is, the main inflation gauge we all feel in our wallets, it just rose 3.8% year over year. That is the highest annual increase since, May of 2023.
Yeah, exactly. Yeah. And what's really fascinating here is the underlying engine of that 3.8% number. It's not just a slow general creep across the board.
It's energy, right?
Totally violently driven by energy prices. The energy index specifically shot up 17.9% over the previous 12 months.
Wow. 17.9.
Yeah. And, energy isn't just an isolated sector. It's a fundamental input cost for literally everything else in the economy.
Right, because if diesel costs more, shipping costs more.
Exactly. If electricity costs more, manufacturing costs more. So when you have a nearly 18% spike in energy, it bleeds straight into the price of groceries, construction materials, services, everything. It means inflation is absolutely not defeated.
Yeah. Which makes the profile of Kevin Warsh himself so critical here. I mean, he isn't just some academic economist who spent his life running theoretical models on a whiteboard.
No, not at all. He served as the Federal Reserve Governor from 2006 to 2011.
Which means he was inside the room working alongside Ben Bernanke during the entire 2008 global financial crisis.
Right. He has deep practical background on Wall Street. He knows exactly how markets behave, how contagion spreads, and how institutional capital panics when things get extremely stressful.
And from what I understand, his history during that 2008 era deeply informs his worldview today. Like, he's known as a monetary hawk, right?
Yeah, widely recognized as a hawk in macroeconomic circles. And for those who might not know, a hawk is someone who is inherently skeptical of easy money policies.
Like keeping interest rates near zero or printing massive amounts of money to buy bonds.
Precisely. Hawks are hyper-vigilant about inflation destroying the purchasing power of a currency. They generally believe that if you let the inflation genie out of the bottle, the long-term economic devastation is far, far worse than the short-term pain of higher borrowing costs.
Okay, wait. Let me challenge the political dynamic here then. If Warsh is a known hawk and President Trump is openly demanding lower interest rates to fuel economic growth, I mean, isn't this an immediate collision course?
Oh, it's a massive collision course.
Right, because why would a president who is hyper-focused on lowering borrowing costs appoint someone historically opposed to easy money? And what happens if Warsh actually gives in and cuts rates too early just to appease the White House?
Well, this raises a really important question about the structural tension between the executive branch and the central bank. And we have to look at this impartially, because both sides are operating on mandates that are fundamentally at odds right now.
Right, they just have totally different goals.
From the White House's perspective, lowering interest rates is the ultimate lever for domestic growth. Cheaper borrowing fuels the housing market because mortgage rates drop. It allows businesses to finance new factories, hire more workers.
It boosts consumer spending and drives up stock prices.
Yeah, if your goal is a booming, highly visible economy, you demand lower rates.
But the Federal Reserve's primary mandate isn't to guarantee a booming stock market, right? Or to assist the executive branch with economic optics.
No, their dual mandate is maximum employment and price stability.
So if Warsh cuts interest rates right now, while inflation is sitting at that 3.8% and energy is surging,
He basically pours gasoline on the fire.
because the cost of borrowing drops, you expand the money supply.
Right. People and businesses take out more loans, demand for goods goes up, but the supply of those goods hasn't changed. The inevitable result is that prices just accelerate even faster.
But on the flip side, if he refuses to cut rates, he defends the purchasing power of the dollar, but he triggers a massive political conflict by deliberately slowing down U.S. economic growth.
That's a brutal balancing act.
Okay, so let's trace the causality here. Let's say Warsh holds the line. He embraces his hawkish roots, he fights that 3.8% inflation, and he keeps U.S. interest rates high.
Okay.
The consequences of that decision do not stop at the U.S. border. I like to think of it like this. Instead of a vacuum cleaner, think of high U.S. Treasury yields as a massive financial black hole that literally bends the orbit of global currencies.
Oh, I really like that black hole analogy. Because the mechanics of global capital flows are entirely dictated by yield and risk.
You're right.
Institutional capital, pension funds, sovereign wealth funds, massive asset managers, they have a fiduciary duty to find the best, safest return. If the Federal Reserve keeps the baseline interest rate high, the yield on U.S. Treasury bonds becomes incredibly attractive.
Because U.S. Treasuries are considered basically the safest asset on the planet.
Exactly. If Kevin Warsh is offering a guaranteed risk-free 5% return backed by the U.S. government, institutional capital doesn't just trickle out of risky or emerging market, it violently snaps back to the United States.
And the black hole turns on.
Yeah, the black hole turns on. And when trillions of dollars in global capital pivot to buy U.S. treasuries, they have to buy them in U.S. dollars. That massive surge in demand skyrockets the value of the dollar against almost every other currency on Earth.
Okay, wait, let me push back on why this is framed as a crisis for the rest of the world. Because for you, the American listener, a supercharged dollar sounds fantastic.
Rate does sound great on paper.
Yeah, it makes imported electronics cheaper. A vacation to Paris becomes incredibly affordable. Furthermore, doesn't a strong dollar actually make it cheaper for massive American tech companies to buy foreign components? Why is the strong dollar painted as this global negative if American buyers are paying with a premium currency?
Well, that assumes the global supply chain operates on a flat, stable playing field. And it really doesn't. You have to look at the liability side of the global ledger.
Okay, explain that.
A massive percentage of global business, especially in developing nations and emerging markets, is conducted through dollar-denominated debt.
Meaning they borrowed in U.S. dollars, not their own currency.
Right. Imagine a foreign energy company or a manufacturer that took out a $100 million loan to build a factory. They have to service that debt, make their monthly payments in U.S. dollars.
Oh, I see.
Yeah. So if their local currency drops 20% in value compared to the dollar, because all that capital fled to U.S. treasuries, their monthly loan payment basically just increased by 20% in their local terms, even though they didn't borrow a single extra dime.
Wow. So a surging dollar acts as a global wrecking ball for anyone holding debt outside the U.S. It crushes emerging markets and suffocates export-driven economies that rely on importing raw materials priced in dollars.
Exactly. And if we connect this to the bigger picture, the pain is most acute for countries that don't have their own natural resources. They are forced to take their weakened local currency, convert it into supercharged U.S. dollars, just to buy the basic oil and gas needed to keep their lights on.
Which perfectly illustrates the next link in the chain and why we're talking about this on the Korea Research Channel. If the dollar becomes this inescapable black hole, who gets suffocated first? You don't look to Europe. You look to an economy that has to import its energy in dollars, but export its technology to survive.
You look at South Korea.
Exactly. Now, I know most people listening probably don't wake up, pour their coffee, and immediately check the exchange rate of the Korean won. But South Korea is basically the ultimate shock absorber for the global economy right now.
It really is. South Korea represents a fascinating convergence of vulnerabilities. I mean, they are a highly advanced, indispensable economic ally to the U.S., but they are deeply, deeply sensitive to dollar liquidity.
Because they sit right at the intersection of global capital flows and massive tech exports.
Yes. And crucially, they import almost 100% of their energy.
Okay, so put us inside the room at the Bank of Korea, the Korean Central Bank. Warsh keeps U.S. rates high to fight inflation, the U.S. dollar surges, and the black hole is pulling capital out of Asia. What is the mechanism that traps the Korean Central Bank in this scenario?
They get caught in what economists call the global hierarchy of money. You see, the Bank of Korea is staring at a highly leveraged domestic population. Korean households carry a significant amount of variable rate debt, largely tied to real estate.
So in a vacuum, the central bank would want to lower their own interest rates to give those everyday people some financial relief.
Exactly. In a vacuum, yes. But the Bank of Korea does not operate in a vacuum. They operate in Kevin Warsh's shadow.
Because if they cut their rates, the gap between U.S. rates and Korean rates gets too wide.
Precisely. If the Bank of Korea cuts rates to, say, 3%, while U.S. Treasuries are yielding 5%, the capital flight accelerates. Global investors dump Korean assets, dump the Korean won, and move their capital to the U.S.
And the value of the won just plummets against the dollar.
It craters.
And a plummeting won is catastrophic for Seoul because of the energy mechanics we discussed earlier. South Korea has to buy oil, natural gas, and coal on the global market to power their massive manufacturing sector.
And all those commodities are universally priced in U.S. dollars.
Right. So if the won is weak, the sheer cost of importing energy just skyrockets.
Yeah, and that dynamic forces a brutal reality on the ground. The higher energy costs immediately drive up the cost of domestic manufacturing, the cost of transportation, and the cost of food in the local grocery store. A weak won literally imports inflation directly into the Korean economy.
Man. So to prevent the currency from collapsing and inflation from running out of control, the Bank of Korea is structurally forced to keep their own interest rates painfully high.
Right. They are effectively punishing their own citizens with high loan payments just to defend the won against the U.S. dollar.
Oh, wow. So the Fed isn't just fighting American inflation, they're accidentally setting the baseline price of electricity and the cost of a mortgage in Seoul.
Yeah, that's exactly what's happening.
I never fully put those two specific mechanics together. The Korean won isn't just a local currency then, it acts as a real-time global early warning system.
It really does. When the won starts weakening sharply, it is the market signaling that global investors are bracing for the Federal Reserve to keep rates higher for longer. It's the physical manifestation of sticky global inflation.
This is exactly why macroeconomic gravity is so difficult to escape. Central banks outside the U.S. are just constantly forced to choose between domestic stability and currency defense.
Always. It's an impossible choice.
Now, here's where it gets really interesting for you, the listener, because you might be thinking, look, I don't hold a portfolio of Asian currencies, and I don't live in Seoul, so why does this matter to me?
Yeah, a fair question.
But the answer is literally sitting in your pocket right now or processing the algorithms on the screen in front of you. This entire geopolitical squeeze directly dictates the future of the massive AI boom sweeping the globe.
Absolutely. South Korea is not a peripheral player in the global economy. It is the geographic home of tech titans like Samsung and SK hynix.
The absolute bedrock of the global memory chip industry.
Yes. And I think when the average person pictures the AI revolution, they picture software, right? They picture large language models, chat interfaces, or, lines of code floating ephemerally in the cloud.
Right, but the cloud is heavy.
The cloud is unbelievably heavy.
Yeah.
And it is incredibly capital intensive. The AI boon requires vast physical infrastructure.
Like advanced memory chips.
Exactly. Specifically HBM, which is absolutely essential for AI processors to function. It requires massive, hyperscale data centers that span the size of multiple football fields. And those data centers require mind-boggling amounts of electricity and advanced liquid cooling systems so the servers don't literally melt down.
And South Korean companies manufacture the most critical bottlenecked components of this physical infrastructure.
They do.
So let's break down the mechanism of how Kevin Warsh's interest rates actually disrupt that specific hardware supply chain. High bandwidth memory chips aren't just regular tech widgets you can stamp out in a garage.
Oh, no. They require multi-billion-dollar fabrication plants that take years to construct.
And you cannot build a multi-billion-dollar fabrication plant with cash on hand.
Nope. Tech manufacturing at that scale relies entirely on corporate debt markets. You have to borrow massive amounts of capital to fund the research, development, and construction of next-generation chip foundries.
Okay, so trace the dominoes for us. Warsh keeps U.S. rates high, the dollar surges, Korea gets squeezed. How does that physically hit the AI industry's cost structure?
Okay, imagine you are an executive at a Korean chip maker. You are suddenly hit by a synchronized financial storm.
Okay.
First, the weak one means it costs you significantly more to import the colossal amounts of energy required to keep your fabrication plants running 24/7.
Right, energy costs explode.
Second, the Bank of Korea, who we established, is forced to keep their rates high to defend against the Fed, has made domestic borrowing incredibly expensive. So the cost to finance the construction of your new HBM factory just skyrocketed. Your operating margins are being crushed simultaneously by energy costs and debt servicing costs.
And companies like Samsung or SK hynix aren't just going to absorb those billions in added costs out of the goodness of their hearts, right? They aren't going to just subsidize the global AI boom for free.
They absolutely will not. They pass every single cent of those costs up the global supply chain. The HBM chips get drastically more expensive.
And when the memory chips get more expensive, the AI servers built by companies in the US become more expensive.
That's exactly. The entire capital expenditure required to build out a new data center balloons. So when Kevin Warsh sets the cost of money in a boardroom in Washington, he isn't just managing the U.S. employment rate, he is indirectly dictating the capital cost, and therefore the pace, of the next generation of human technology.
That is a fascinating realization. We tend to view the AI boom as this unstoppable force of pure technological innovation, completely immune to standard economic gravity. But it's not.
Not at all.
You can have the most brilliant software engineers on Earth writing perfect code, but if a central banker in DC makes the physical hardware too expensive to finance, the entire revolution hits a wall.
It really reveals the hidden leverage of monetary policy. The velocity of technological innovation is fundamentally tethered to the price of debt.
Okay, so what does this all mean for you, navigating this Warsh-led Fed? Let's bring all these massive macroeconomic concepts, yield spreads, capital flight, dollar-denominated debt, AI supply chains back down to earth. What is the real-world impact on the American household?
Well, there are three very direct ways this policy matrix hits your wallet.
Okay, let's hear them.
First is the baseline cost of borrowing. If Warsh stays true to his hawkish history and holds rates high to fight that 3.8% inflation, you're going to see elevated rates for a very long time.
Meaning the 30-year fixed mortgage rate, the APR on your credit cards, the financing rate on a new car.
Or the cost of a small business loan, yeah, those are not coming down. The era of cheap money is structurally over.
Ouch. And the second way, I imagine it has to do with your retirement portfolio, specifically how high rates impact the growth stocks that dominate most 401ks.
Exactly. The mechanism there is really crucial to understand. A high-rate environment puts immense pressure on the stock market, specifically the tech sector.
Why tech specifically?
Because the valuation of a growth stock is fundamentally based on its future expected earnings. But when interest rates are high, financial analysts apply a higher discount rate to those future earnings.
Wait, discount rate. Explain that simply.
In simple terms, a dollar earned 5 years from now is worth significantly less today if you can get a guaranteed 5% return on a safe treasury bond right now instead.
Ah, right. So the present value of those massive tech companies drops, creating deep volatility in your investment portfolio.
Exactly. But conversely, if you're sitting on cash or shifting toward bonds, you are finally seeing a meaningful yield for the first time in over a decade.
True. But the third impact, though, is what happens if the political pressure actually works.
Right. If Warsh decides the political heat from the White House is just too intense and he bends to the demand for lower rates while inflation is still hot, that 17.9% energy spike will inevitably metastasize.
You will feel it immediately.
Oh yeah, the cost of groceries will accelerate, utility bills will climb, and the purchasing power of your paycheck will erode. It is essentially a binary choice for the Fed. Inflict the pain of expensive debt or inflict the pain of a devalued dollar.
It is incredibly telling how closely this mirrors what the Korean household is experiencing right now, just operating through different financial plumbing.
That's a great point.
I mean, the family and soul is hurting because a strong U.S. dollar forces their country to import inflation via expensive energy, and their central bank is completely paralyzed, unable to lower their loan burdens without collapsing the currency.
And the American family is hurting because of domestic inflation and high borrowing costs engineered to slow down the economy.
Right. It's a different continent, a different currency, but it is the exact same human struggle with the fundamental price of money.
If we pull all the way back, it just proves that national economies are not walled gardens. We treat them like sovereign, independent ecosystems, but the Federal Reserve is the one institution that proves the walls do not exist. The financial shockwave completely ignores borders.
Absolutely. So, to summarize the massive ground we've covered in this deep dive, later today you are going to see a notification on your phone. A seemingly dry, bureaucratic headline that says, Senate confirms Kevin Warsh, or next month, Fed holds rates steady.
Yeah, and it is so incredibly easy to swipe past that and look for something more exciting.
But you shouldn't, because that boring headline is the master thermostat clicking on. It is a transmission mechanism that dictates your mortgage, shifts the gravity of global capital markets, traps foreign central banks into punishing their own citizens, and literally sets the multi-billion-dollar price tag for the hardware running the global AI revolution.
This raises an important question, something I really want you to mull over after we wrap up today.
Let's hear it.
We have thoroughly established that the sheer cost of capital required to build the future of AI is deeply tied to U.S. monetary policy. So, if that capital cost gets aggressively squeezed by a political tug-of-war in Washington, could the pace of human technological progress ultimately be dictated not by our brightest engineers or our most innovative founders, but by whether a single central banker decides to bend to political pressure?
Man, that is a haunting thought. A technological bottleneck created entirely by the politics of the dollar.
It really makes you think.
Yeah, it does. Well, this has been Korea Research. Thank you for joining us on this deep dive into the Federal Reserve, global capital, and the hidden cost of the future. Please remember to like the video and subscribe to the channel if you haven't already.
Thanks for listening, everyone.
Remember, in today's intertwined economy, the thermostat might be mounted on a wall in Washington, but the shock never just stays there. Sometimes it lands in Seoul first.